The path for public investment is presented in Panel A, where time is measured in years. Public investment is front-loaded. It starts at 6% of GDP, reaches almost 9% by year 5, and gradually stabilizes at a long value of 7% of GDP. Given this path, we use the DIG model and a calibration of an average developing country to simulate the macroeconomic effects on key variables, including on growth, private consumption, and private investment. The other panels summarize these effects by showing the transition dynamics over a period of 30 years. The public investment surge increases the stock of public capital, Panel B, which raises the productivity of all factors and stimulates the accumulation of private capital by the end of the simulated period, Panel C. As production inputs, including public and private capital, grow, so does real GDP, Panels D and E. Debt, measured as percentage of GDP, decreases over time since GDP increases and, by construction, there is no borrowing, Panel F. Despite some positive effects on real GDP growth, the transition dynamics are, to some extent, discouraging. The fiscal adjustment to cover the fiscal gap associated with the public investment surge turns out to be demanding. The tax rate rises from 15% to 19% in the first years, Panel G, and, after year 6, it decreases because financing needs drop as public investment is on a declining path. During the first years, the increasing tax rate reduces private consumption, Panel H. As mentioned in the previous section, the effect of the tax rate on consumption is called a general equilibrium effect. In the model, consumption is an equilibrium choice of consumers who choose to consume less when facing higher taxes. Moreover, higher real interest rates, not shown in the figure, affect negatively private investment, Panel I. In models like DIG and DIGNAR, in which some consumers can save and the tax rate affects consumption, the interest rate is positively related to consumption growth and to tax rate increases. In the simulations, even if consumption declines, the increase in the tax rate more than offsets this decline, pushing the interest rate up. In sum, the fiscal adjustment crowds out private consumption and investment. Relative to their initial levels, private consumption decreases by about 2% in year 5, and investment falls by 1.6% in year 3. These crowding out effects are protracted. For instance, the consumption decline lasts for almost a decade, which also explains the need for a stronger fiscal adjustment, that is, very high tax rates in the first years. Overall, these crowding out effects diminish the real benefits of the public investment surge.